This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
So I closed out last month on the real estate side, sold 3 houses, got 2 more under contract. It's been a long time coming, but all that stuff that Jason and the rest of the team and I have been working on since Jacksonville, all coming through. So all good stuff.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Good day, empowered investors, and welcome to episode 2126. Thank you for joining me. Today, I want to talk about the many, many reasons over the last 14 years or so not to invest in real estate, not to invest in income properties. Before that, got a couple things I want to talk to you about from last night. So I wanted to just give you all a little recap of our Empowered Investor Pro meeting last night. If you're not a member, you're missing out, but I'll share with you a few things that might be very educational for you. So first of all, we had a very long meeting last night, but it was great seeing everybody. And we spent 2 hours and 1 minute talking all about investing, about best practices, about self-management. We had a special guest from Baselane on who did a very deep educational demo of their software and their banking product, and that was really great. And then we talked about self-management and how more and more people are taking control of their portfolios and self-managing. And also, we had a really good question. I mean, we had a whole bunch of good questions, but one of them that I remember particularly came up last night toward the end, and it was about, if you've made money with your real estate investments and you're satisfied with your portfolio and you want to scale back, maybe you want to retire completely and just put everything completely on autopilot. Well, we definitely teach you a lot about how to make it simpler and easier to manage your real estate portfolio. Of course, that's what we do here. We've done that for a long, long time. But what if you just want out? Right? What do you do? Because with the 1031 exchanges, you're kind of in a trap. If you sell your properties and you don't do a 1031 tax deferred exchange, well, then you got to pay capital gains tax. Now, it's a lot better than paying income tax because it's much cheaper than that. However, it is nonetheless a tax. And many of us real estate investors, we're used to having the most tax favored asset class in America. And we're used to really getting a very good deal tax-wise. So we become somewhat allergic to paying taxes. Okay, fine. Well, there are some things you can do. And if you want to get individual coaching with me, for my individual coaching clients, I really dive deep with them on any topic they want. After doing this so many years and investigating so many things, I have deep knowledge of a lot of topics because I've done them myself. One of the things I talked about is that you can set up a captive insurance company. And I did that many years ago. It's been great. There are some pitfalls and some things you definitely want to watch out for. But, if you want to get individual coaching with me, you want to get referrals for these different providers and vendors that can help you do some of these, maybe I'll call them more creative or more esoteric strategies, not used by the masses. Get with me on that. Happy to help you with one-on-one coaching on any of these things. So captive insurance, that's one way to definitely reduce tax liability, where you basically become your own insurance company and your insurance premiums become tax deductible. Now, I always want to say check with your tax advisor. I am not a CPA. I am not licensed to practice taxation. I'm only talking about my own personal experience, right? Check everything I say with the appropriate advisor. And, if you need referrals to these advisors, we can help you with that too. And we had one on our Empowered Investor Pro meeting as well last month, where he talked all about deep creative tax strategies and so forth. Okay. Anyway, so captive insurance, that's one really interesting thing. Formerly only used by the ultra wealthy set, but now it's becoming more common and used by people at more middle and upper middle class wealth and income levels because there's just been a wider array of services, a wider array of providers that provide these things. Okay, so captive insurance, that's one thing. Cryptocurrency. Look, cryptocurrency, I would love to see Bitcoin especially succeed like crazy. I don't really have a ton of faith that it will, only because the two most powerful forces in world history are governments and central banks. And Bitcoin or any other cryptocurrency represents competition for their main product. What is a country's main product? What is a central bank's main product? It's their currency, of course. I mean, do you think the United States Federal Reserve wants, or the United States government wants a competitor to the US dollar? Of course not. They will defend the dollar to their last breath. And they do that now. They send aircraft carriers around the world to defend the dollar. They invade other countries to defend the dollar. Wars and many, many deaths happen over nations' currencies. That's how important it is. Okay, we've got that. Do you think the European Central Bank or the Bank of Japan wants competitors for their currencies, the euro or the yen? Of course not. I hope I'm wrong. I would love to see a decentralized currency of the people that can't be inflated away. I would love to see that take over the world. So I do buy some of it to hedge my bets. But again, I don't think it's going to be as wildly successful as everyone hopes, but I hope I'm wrong. I hope it is wildly successful. Anyway, not the point here, lest I get off on one of my many tangents. That's a tangent alert. Okay, tangent alert. All right. Anyway, back to the point. Cryptocurrencies have a really cool tax feature, and this is it. You can lose money on them, you can sell them and take a capital loss, and you can rebuy them unless the law has changed. This is what my CPA advised me, and this is what I've read elsewhere. So check with your advisor. And you can buy them back a minute later at the same price, and you start all over again. So if you have losses in a cryptocurrency, which at the moment of this recording, you probably don't, okay, well, it depends what the cryptocurrency is, but in Bitcoin, you're probably up. Now, the funny thing about the Bitcoin record high prices everybody's bragging about is they're not. Well, what is it? You know what it is. All of you listening to me for so long, you know what I'm about to say. They're not adjusting for inflation. See, when you adjust for inflation, the Bitcoin price really changes subject to inflation, right? Because it's always being quoted in US dollars, but the US dollar ain't worth what it used to be, right? So the record high isn't really the record high. You've got to adjust for inflation. Now, Baselane, our sponsor, it is the #1 banking platform built for real estate investors. It's banking, online rent collection, bookkeeping, tax reporting, analytics, and more. You can enjoy real-time cash flow analytics on your properties. You can get ready for tax season with automated bookkeeping and financial statements ready for your CPA. Join more than 40,000 real estate investors who trust Baselane to manage their rental property finances. Go to baselane.com/Jason for a chance to win a $500 Amazon gift card. But you really need to adjust for a whole basket of things. And that's why I created the Hartman Comparison Index, the HCI, to help us understand the real value of especially real estate, but really anything else, okay? And that's why the Consumer Price Index, as flawed as it is a basket of goods, right? You can't just compare it to one thing. You got to compare it to a whole basket. All right, enough said on that. So cryptocurrencies do offer some interesting capital loss tax benefits. Now, you have to lose money, right? And nobody wants to lose money. But if you lose money on the cryptocurrency and you gain money on your real estate, you can offset those things, right? So that's kind of a cool feature. Okay, what's the next thing? Cash balance plan. If you have a business, and depending on how much you are, even if you don't think you have a business, depending on how much real estate you own, if you have a lot of income properties, well, even one income property is a business. But if you have a portfolio, that is like a real business. And you could potentially set up a cash balance plan. And this is one of the reasons that you want to have entities, you want to get these entities structured. And, forgive me, I don't have the domain name. Hopefully I got this right, but jasonhartman.com/protect, where you can get entities set up, LLCs, corporations, trusts, living trust, or irrevocable asset protection trust, really inexpensively. Okay. So we have an affiliation with a law firm that does this really at very, very reasonable prices. And it's a real law firm, not one of these mills where you're not getting, an actual lawyer. This is actual lawyers. Okay. Anyway, so jasonhartman.com/protect. Get your entity structure set up, and then you can do a lot of these more creative things, like have a cash balance plan, like have a captive insurance company. So there are things you can do. Of course, you can do a 1031 tax deferred exchange. That's fantastic. And I've used it many, many times with my own portfolio. I've talked about it, demonstrated it on the show many, many times. But the question was, what if you want out? What if you just want to retire? You've made enough money. You're rich, right? You don't need any more, okay? And so you just want to get the do-nothing life. And so there are options. There are creative options. Oil and gas is another option that has interesting tax benefits, but highly risky, okay? Very risky. And there are many layers to it and many different sort of market segments of oil and gas or energy or solar. Solar has some interesting things too. There are R&D tax credits if you have a business again. So there are creative things you can do. Okay. I just want you to know that. Set up a one-on-one coaching session with me if you're interested in this. We'll put the link in the description, and I can help guide you individually and refer you to the right professionals that can help you do all of this stuff, whether it's taxation, entity structuring, captive insurance, cash balance plan, even offshore planning for offshore entities or second citizenship, stuff like that. We've got all these different referrals and all this kind of stuff. So book an individual session with me, and I'd be glad to help you with that. We'll put the link in the description. All right. What else do we have? That was last night's call. We had a bunch of stuff on that. Oh, we talked a lot about the lease options and the rent to own, and we have a revised offer here for you as well. If you go to fireyourmanagers.com, we've got a completely new program, new and revised. You can get the recordings from our last program that we did live. So check that out at fireyourmanagers.com. Scott is willing to work with anybody individually on lease options. We've got two big success stories from our clients already this early on their rent to own deals and lease option deals. So you'll hear more about that later. All right, let's talk about the reasons not to invest in real estate. Okay, that's what I really want to focus on today. All right, so when you look over the last 14 years or so, people have always had reasons not to do something, not to invest in real estate, right? There's always a reason, and it seems so good at the time. Always an excuse not to take action. Always a justification for lack of confidence, for, taking the sort of fallback, weak position that usually just puts people in the coulda, shoulda, woulda regret frame later. So I compiled a bunch of reasons, and I did it year by year. And of course, there are many more reasons, many more very reasonable, justifiable excuses or reasons that you could have had over the last 14 years not to invest. But here are some of them. I just thought I'd share them with you. All right, 2010. Post-financial crisis fear, the lingering effects of the 2008 financial crisis made many wary of investing in real estate, fearing another crash. High unemployment rates, continued high unemployment rates led to concerns about the economic recovery's stability and the real estate market demand. Okay, 2011, double dip recession concerns were what everybody was talking about. The fears of a double dip loomed large, causing hesitation, making significant financial commitments. People didn't want to do it. They wanted to just keep their powder dry, keep their money in cash, right? The European debt crisis, global financial market instability due to the European debt crisis raised concerns about potential spillover effects in the United States real estate market. By 2012, what were people saying then? Slow economic recovery, skepticism about the strength and sustainability of the US economic recovery, and some cautions about investing. Market volatility, ongoing volatility in the markets, and uncertainty in the aftermath of the global financial crisis. That was what they said in 2012. How about 2013? What did they say then? Well, they said interest rates. They were worried about interest rates. There was a lot of anticipation about how rates would go up, making potential investors nervous about increasing costs of mortgages. And there was all this stuff and all this concern about government shutdowns, how that would just bring the economy to a halt. The US government shutdown and the debt ceiling debates raged on. They were all over the news, and it made everybody very fearful about economic stability. By 2014, they were worried about a market bubble. Their concerns were that real estate prices in some markets were overinflated, posing the risk of another bubble. Global political tensions, escalating political tensions, including conflicts in Ukraine. Remember, there was a prior Ukraine conflict, not the one we're going through now, a prior conflict, which, by the way, when Russia invaded Ukraine this time around, you could have had all the justifications for not investing. And in the last couple of years, look at what you would have missed out on, right? So Ukraine and the Middle East, of course, they contributed to all these geopolitical uncertainties, okay? By 2015, they were worried about the oil price crash. The dramatic fall in oil prices led to economic shutdowns in energy-dependent regions, affecting real estate markets. That was 2015. Interest rate hikes, the Federal Reserve's decision to raise rates for the first time since the financial crisis made borrowing more expensive. And potential investors thought they shouldn't invest in 2015 because they were worried about mortgages getting more expensive. Well, by 2016, what were they worried about then? Well, Brexit. Right? Brexit was all over the news in 2016. The UK's vote to leave the European Union created global economic uncertainty, affecting investor confidence. And then there was that crazy US presidential election. Remember how the country was so divided? Everybody hated each other. You put something on social media about Trump and people just jumped all over you. Do you remember those debates? I thought they were hilarious, but all of the stuff Trump said that just, oh my God, it was so entertaining. It was so politically incorrect, right? Okay, the presidential election, that's what they said. And by the way, remember we were doing shows then about the business cycle and how the business cycle was long in the tooth. And that was the concern about, the real estate market changing. All right, 2017. Well, then what was the concern then? The uncertainty about tax reform. Oh my God, what is the new tax law going to be? How is this going to affect the real estate market? I better just wait. Better wait, better not invest in 2017, because beyond the Tax Reform Act, that was a huge concern. What about rising home prices? Rapidly rising home prices in many areas led to concerns about affordability. I've never heard that before. And the sustainability of all that market growth that we already had. So that was a good reason in 2017 not to invest, because we were definitely in a bubble. By 2018, the trade wars. Wow. That was all the talk. The US and China, all the Trump haters hated Trump for what he was saying. But interestingly, Biden basically kind of continued the Trump policies, although nobody's on his case about it, right? It's just amazing. You can't make this stuff up, folks. Okay, so 2018, trade wars. The initiation of trade wars, particularly between the US and China, raised concerns about global economic stability. Don't invest in 2018. Rising interest rates, continued rate hikes by the Federal Reserve increased the cost of borrowing, and that really deterred some investors in 2018. And what were they saying in 2019? Wow. We had all kinds of issues going on in 2019, namely behind the scenes. There was a lot of talk about the repo market and how the economy was on the verge of collapse. And that was moving right up to COVID-19 era, right? So right there we were just on the brink of the COVID-19 crisis. Okay, 2020, the pandemic hit. And if you ever had an excuse not to invest in real estate, I'd say that was probably your best excuse, but you would have made a huge mistake. Remember, I did a show then when the lockdown started and all this COVID scare was happening. And I said, new investors should not invest. Do not call us. We're not going to sell you a property. Okay. Like I actually said that, right? To talk about business suicide. Okay. But after a couple months of getting the hang of what was going on in the world, I retracted my statement. And we did have a lot of people who invested and made a ton of money, by the way. Okay, so congratulations to all of you who had the faith to invest, because what people really never interpret right when they try to predict the economy is they never really interpret properly the government's and the central bank's reaction to the crisis. And that's what is really important, right? It's not the crisis itself a lot of times. It's their reaction to it that you can make money from. Okay. So 2020 COVID-19 pandemic created unprecedented economic certainty, disrupted real estate markets, disrupted the whole world economy, for God's sake. Lockdowns, economic shutdowns, government imposed lockdowns resulting in just, fears about rent collection and property values and everything, right? Okay. 2021, they're calling that pandemic aftermath. I think it's really still pandemic era. Okay. Uncertainty about the pandemic's long-term impact on commercial and residential real estate markets. It wasn't just commercial back then. People were, they thought residential was, gonna really tank. Okay. Inflation fears, rising inflation, supply chains. Remember all of that discussion? Just go back to my old episodes and listen to them. You'll hear the whole story, okay? 2022, interest rate hikes, aggressive rate hikes by the central banks to combat inflation made mortgages dramatically more expensive and cooled market enthusiasm. And then all those recession predictions in 2022, the recession that never happened, all the doom and gloomers, all the clickbait titles all over YouTube, recession is coming, never happened, right? So that was 2022. Well, let's move on to 2023. Continued inflation and rate hikes, persistent inflation, further interest rate hikes continued to raise the cost of financing, economic uncertainty, yada, yada, yada. This is more recent, so we don't have to, go into it too much, but we all were there. We were talking about it. This is just last year, okay? And yet, even with the rate hikes, the most resilient asset class in the entire world, the most historically proven asset class in the entire world, the most tax-favored asset class in America, income property has won the game. It has survived all of this, right? And amazingly, it survived tripling the cost of money. That's incredible, folks. It really is incredible that you could triple the cost of money and real estate values would still increase. It's amazing. It's an amazing asset class. What are the concerns for this year? What are they projecting are the concerns? Well, interest rates still are definitely a concern. The real estate market adjusting to potentially higher long-term rates. We thought the Fed would pivot, and they're going to pivot, but they're being pretty stingy about that pivot. They're making us wait for it. They're definitely making us wait for it. And an overall global economic slowdown, concerns about this, definitely are causing people to be concerned about real estate. But look at how well the job market's holding up. Look at how low the inventory is. Remember my sink metaphor. If you look at the real estate market as a sink, the faucet, the water coming in the sink represents new listings, new properties coming onto the market. The basin of the sink represents the existing inventory, and the drain represents the buyer demand, right? The buyers buying the properties. So with all that in mind, we've got a sink that is only about 40% full, assuming that a full sink is a normal market. An overflowing sink is a down market, a bad market, a buyer's market, right? We've got a market that the sellers just won't give up the inventory. So we have very, very low inventory, and we've talked about that ad nauseum on prior shows. All right, that's it for today, folks. Reach out to us. Oh, join us for the cruise. Be sure to join us for the cruise. That's going to be our next best thing coming up. Also, we have a Zoom meeting next week. The second Wednesday of every month, we're having a special Zoom meeting on a special topic. And we've got one of our local market specialists for that. So look for a link for that on future episodes or in your email box. Be sure you are signed up to get our emails. Just go to jasonhartman.com and you can get those. And we will talk to you on the next episode. Happy investing.
As one of Jason Hartman's listeners, you will have heard him encourage you numerous times to be a student of history, to always look for that invaluable context, that historical backdrop in which to frame everything, to give you a more complete picture of the world today through the lens of history. So why look backwards? Because history is replete with examples of countries enjoying shocking levels of prosperity, to then later transform into basket cases decades later. That's how civilizational cycles work out. But it's not just confined to the West. The African continent has had its fair share of once economically prosperous countries turning into dumpster fires. At one point, Zimbabwe was viewed as Africa's breadbasket and one of the few countries that appeared to transition out of its previous colonial status without many hiccups. So what exactly can Zimbabwe teach investors about jurisdictional diversification? Led by Prime Minister Robert Mugabe from 1980 to 1987, Zimbabwe was breaking the mold as one of Africa's success stories. Although Mugabe was marketed as a revolutionary, he was rather pragmatic in his economic stewardship of the country during his early years in office. Mugabe maintained many of the features that made Zimbabwe's predecessor state, Rhodesia, prosperous. However, he always had a radical agenda up his sleeve, but generally concealed it in his initial years of power. It wasn't until Mugabe became president in 1987 that the country began taking a different path. But things started changing towards the start of the 21st century. Mugabe began pursuing ambitious land reforms that ruffled the feathers of many elites and upwardly mobile economic actors. He met a roadblock in 2000 when voters rejected Mugabe's efforts to confiscate white-owned farms at the polls. But Mugabe was not deterred. He relentlessly pushed for land confiscation and was able to get his wish of expropriating the land holdings of white property owners. By using political and paramilitary means, Mugabe ended up confiscating 23 million acres of land without any form of due process or compensation. But Mugabe didn't stop there. He pursued an inflationary monetary agenda by turning the Reserve Bank of Zimbabwe into a personal printing press that suited his political needs. The monetary policy Mugabe carried out was the most hyperinflationary in recent memory. For example, hyperinflation reached cartoonish levels of 79.6 billion% in 2008. After thoroughly trashing the value of the local currency, Zimbabwe had to embrace dollarization and turn to outside currencies such as the dollar and the African rand. Even worse, Mugabe's government attempted to fight inflation in the most futile manner possible through its implementation of price controls. This policy has been an abject failure everywhere it's been implemented, from ancient Rome to present-day Venezuela. The price controls only worsened the existing shortages and accelerated Zimbabwe's economic debacle. Mugabe was eventually deposed in a coup in 2017. At that point in time, 70% of Zimbabweans were living in poverty, and the country's economic output had plummeted by half since 2000. On top of that, real per capita income had fallen by 15% since 1980. Mugabe's successor, Emerson Mnangagwa, is still facing inflation problems, with inflation presently hovering around 60%, a marked decline from previous years, but still an alarming level of inflation. What you can learn from the Zimbabwean case study is that political jurisdictions can be stable one day and go completely haywire the next. While the U.S. is far from descending into Zimbabwe status, there are states that are much more economically stable than others, so you must always plan accordingly when settling down in one area. America has 50 states that vary not only in terms of their cost of living and housing arrangements, but also in their political profiles. This carries over into how housing is regulated. Generally speaking, although there are a few exceptions, pro-business states tend to be more landlord-friendly. So if you're dealing with a deadbeat tenant, you can evict them in states with higher degrees of economic freedom. Think along the lines of states such as Texas or Florida. So let's not forget the invaluable lessons that history has given us. When you look back at your own history, make sure your story is a success. For more information, visit jasonhartman.com.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.